Guys, it's the first week in 2024 that the S&P 500 has closed red. Is this the end of the crazy rally to start 2024? Let's dive into it. My name is Hamilton. I'm here with the Trading Initiative, and in this week's Markets in Focus, wrapping up February 16th, 2024, we're going to talk about the good, the bad, and all of the in-between. Without further ado, let's start off with our intermarket analysis, where we focus on the most important areas of the market, get a general snapshot of how it worked. And so far, Bitcoin outperforming again. I think this is the second week in a row that Bitcoin is up and leading, up 7.89% as of right now. We're up and over 50K. For everybody that was looking to massively short Bitcoin off of the ETF introduction, that has completely reversed, and we are now pressing into new higher highs. We do think that this is a primary uptrend in Bitcoin that is probably going to propel us to all-time highs sooner rather than later, meaning that before we see another 10K Bitcoin price, we're probably going to see somewhere north of 65, 70K. I definitely think that's in the cards. The trends are up. It's well up and over the 200-day moving average. I don't care about what you think about Bitcoin, just strictly from a trading vehicle. This is a very bullish looking asset right now. Copper up, oil up. Surprisingly, second week in a row where oil has stamped out a higher high. PPI came in earlier this week. It was red hot. Some of that had to do with the rising price of oil. Obviously, oil goes up. Inflation is also going to come up slightly, and we saw that in the reports. I'm not going to dive into what the PPI data actually said, but it was red hot, and the market obviously did not like it too much at all. Look at the 10-year yields, the 30-year yields, both up on the week as well. If you've been following our content, you know that's not great for our bullish thesis, because over the last 10 months, bonds and equities have been very highly correlated together. And as of right now, over the last 6 weeks at the beginning of the year, bonds and equities have diverged. And so that's definitely a yellow flag for us. It's not what we want to see. We would like to see bonds and stocks moving in the same direction like they were last year. It was an incredible year last year to be long. Right now, we're not seeing that. So age-old question, are bonds and stocks decoupling again? Are they starting to trade against each other once again like they did traditionally for decades? Or is this a big yellow flag where we need to be very worried about a potential breakdown in bonds, which could lead or front run a breakdown in equities? We'll see that in a second. Outside of that, though, and the Russell 2K finally stamping out actually a weekly high, and we did actually pivot up and over the 200 area for the first time, which we're going to look at in a sec. Other than that, this week was actually not that great. It wasn't bad. Really not a whole lot happened, actually. Some individual stocks went nuts, like SMCI, which we're going to see in a second. But from a macro standpoint, really, the market didn't do a whole lot. It finished down like 1%, something like that. Not a whole lot of intra-week movement either. Just really not a lot to write about. So if you're in the bear camp, not a lot happened. If you're in the bull camp, not a lot happened. Let's just go ahead and move on. It was a pretty neutral week. Let's go to U.S. sectors, and we're going to focus on the year-to-date from now on. We're not going to go back into 2023 unless there's a specific data point I want to point out. Comms are leading. Think your Metas, your Googles, your Disneys, your Netflixes, your telecom names like T-Mobile, etc. That's the leading sector on the year. And if you're trading Meta, you know that, because Meta is up into all-time highs this year. It is right now this year's biggest winner for us, and it continues to hit weekly all-time high. So there's no reason to look to front run that close on Meta. Congratulations to those of you that grabbed it. Healthcare, a sector that really nobody's talking about. It's broken up and over a 2-year base. We're going to look at that in a second. And you should probably be hunting for some potential entries into the healthcare sector. The one question I have for you, is this a rotation out of some risk areas into some defensive plays? Or is this going to be a year or two new uptrend that forms in the healthcare sector, seeing that it just based for 2.5 years underneath overhead supply, and it's finally breaking? I don't know what the answer is. We are going to be hunting for healthcare related stocks next week. We have a small watch list right now that we like, that we're probably going to start accumulating. We'll see if those play out. But healthcare should be on your radar regardless, because we're pressing up into all-time highs, and you want to, at the very minimum, have a watch list filled with stocks that are contributing to that. Tech and financials, although tech has come down slightly. It is still in a leadership role, and financials kind of bucking the regional banking stuff. Regional banks looking a little bit weaker, but some of the bigger mega cap and large cap names, JP Morgan, KKR, et cetera, still pressing up into all-time highs. So financials, tech, healthcare, and comms leading on the year. Industrials as well. Industrials is going to be a grab bag sector, lots of different industry groups. So it doesn't surprise me that it's going to be underperforming SPY right now. But industrials are also at all-time highs. It's that other area of the market that is really performing well. And so those 5 sectors, comms, healthcare, financials, tech, and industrials, should be on your radar looking for strength, even if you're not looking to buy right now because of some potential weakness that could be coming. We'll talk about that in a second. Year to date here, looking at the industry groups, semis. I mean, I don't need to tell you that. You should probably already know. Led by NVIDIA, the craziness, SMCI, the craziness. SMCI came down a lot on Friday, and we're going to talk about this more in a second, but is there going to be broader implications, right? Is that going to bring down a whole lot of the frothiness in the semiconductor space? I have no idea. But insurance, industry group number 2. How many people have trades on in insurance? KIE. Not a whole lot. We have a trade on in Allstate and Progressive's up at all-time highs. We scanned through. Those are kind of challenging area of the market to trade, but they are contributing to all-time highs right now, and obviously they're a big portion of the financial sector as well. AMLP. You don't know what AMLP is? It is a sub-industry within the energy sector. So energy, although it doesn't look great as a whole sector group, there are specific industry groups that are breaking out and outperforming the S&P 500. Here's a question. Do the industry groups tend to lead the larger sectors? Yes, but is AMLP an important enough sub-industry group to tell us to basically front-run some of the breakouts in energy? I don't know. It's a really hard question to ask, but kind of like healthcare, is this a defensive rotation or is this a bigger trend that's starting to emerge? I don't know yet. We have no current positions as a community within the energy sector. I don't see us putting anything on within the next week or two, but something to note that energy is starting to show a little something, especially because U.S. oil, right, week over week starting to gain. The positive correlation between U.S. oil and U.S. domestic energy producers is very high. So something to watch there. You have internet names, you have software names, and then the rest are just underneath SPY. They're not really worth trading to the upside whatsoever. So if you're looking to get long, our general rule of thumb is don't get long anything with size that's underneath SPY, right? You want to be focused on market leaders and generally something that is trading, for example, down here, PBW at 14%. Some people talking about like EV energy plays and stuff. Listen, this industry group sucks. As a matter of fact, I think PBW is the worst industry group over the last 2 to 3 years. You shouldn't be looking to buy this stuff if we're in year 2 of a bull market. Look for stuff that's leading right now, and we know what is. Semiconductors, insurance, potentially some energy stuff, which I know a lot of people aren't going to love, internet, software, etc. Really quick, let's look at market cap. Let's look at market cap. Check this out. Over the last, let's go year to date, not 3 months. Large cap growth has been the place to be. Completely goes against the entire theory that we had coming into 2024. We expected smalls and mids to outperform, but that was very quickly invalidated within the first 2 weeks of January. And so we switched it up. We started to get back long the large cap growth names, and it's worked out very well for us, as you'll see in a second. But we're starting to see some bounces as well, right? Large cap growth. This is not necessarily a trend breakdown, but we are seeing a series of lower highs and potential lower lows start. And we're starting to see some other areas start to catch a bid, which we're going to see on an absolute basis as well when we pull up the Russell 2K. Once again, if the Russell 2000 is above that 200 area and you're seeing some relative strength, particularly in some of the leader names, maybe it's time to start taking a little bit of a bite into some of those small mid-cap names. Who knows where the rotation or when the rotation is going to come, but if you're not positioned or at the very minimum don't have a watch list filled with some of these names, you might miss the entire move. We're starting to see a little bit here, not enough for us to push large amounts of capital into the space, but once again, we've been very patient with the small cap, mid-cap trade, not pushing anything in outside of a select few semiconductor and software related stocks. But now going back to the beginning of the week, we're starting to see a little bit of a push. 1 week does not start a trend, but at least it gets it on our radar. So we're going to be watching smalls and mids. All right. So we know where we want to be long, and that's the tech. That is the healthcares, that's the comms, potentially some of the industrial related stuff, the financials. We know the industry groups, and we know the market caps, which are right now still large cap growth, but we're starting to have an eye for the smalls and mids. Let's actually go look and pull up some Twitter stuff really quick. And this is what I want to talk about. This is from JC Peretz, but obviously this particular chart is from Stock Traders Almanac, at Almanac Trader. Jeffrey Hirsch is the one that publishes this right now. Fantastic chart. We've used this all year. This is a great framework for anybody that's looking to trade for the entirety of 2024, particularly the swing traders and position traders that take trades for sometimes upwards of weeks and months. We have a general framework here going back to 1949 that this is probably going to be a pretty bullish year, meaning that we're probably going to want to look for more longs than shorts this year unless price invalidates this thesis. You can see that purple line is 2024. We're coming up on statistically an area of the market that is going to pull back. It's about midway through February. I think the 16th of February is generally the day that it peaks. And this is obviously averaged out. So if it peaked on the 15th, fine. If it peaks early next week, that's fine. But general framework here is middle of February, we tend to peak, and then we pull back into the first week or two of March. Is that going to happen? We don't know 100%, but we are starting to position ourselves for that. We've been starting to position ourselves for that. We're going to go through that in a second. But as of right now, look at the purple line. That's 2024. Is it reasonable to expect that maybe we're going to get some pullback? Well, the market does look a little frothy. We did just place our first red week this year. in the S&P 500. We're seeing continuous degradation. We're starting to see some market leaders break down. Apple, Adobe, some important software related names are starting to break down, right? It's not all peaches and cream. There's definitely some weakness. Is that eventually going to translate to lower highs in the indexes? We think there's definitely a possibility. So although we're not going balls to the wall shorts, we don't have a huge amount of cash into shorts. And even if the market does start to fall, we're not going to chase it. We do have a couple shorts on the books to take advantage of if this happens. And I do think that at the very minimum, you should be prepared for it. Not saying it has to happen, but historically it does happen. So if this is one of those outside of the historical norms, totally fine. Your longs will catch a bid and obviously continue to pay you well. But if it does pull back, you can make a couple bucks on the short side before positioning yourself to buy the pivot, which is the same goal we had last week. Is even though we expect to pull back in the market, we do think 2024 is going to be an incredibly bullish year overall. And so the main scope, at least inside of TTI, is not to miss the pivot. We are probably going to make a couple bucks on the short side if this market does pull back. But the most important part is we're going to make the big bucks buying the dip whenever the dip stops dipping. That's a hard part, right? Hopefully, if you're watching these markets in focus, you're going to catch it with us, or at least around the bottom. So keep this in mind going into next week. There's probably going to be, at least historically speaking, the beginnings of a pullback. The last one I want to talk about before we move on to actual trading view stuff is just this really basic concept that we talk about in TTI all the time. From a swing trading perspective, it's really easy to hoard positions. There's always a question, how many positions is too many? And I always go with 3 to 5 max. Like go 3 to 5 max, especially if you're learning a new system, because you can really put a lot of brain juice into those 3 to 5 trades. High quality decision-making processes, focused in on 3 to 5 names, the old Stanley Druckenmiller quote. I would prefer to put all of my eggs in one basket and then watch that basket type of mentality. That's where you're really going to start to outperform. The problem is, a lot of swing traders will hoard positions, and next thing you know, you have 12, 15, 20 positions on the books. And even if they're technically free, I'm putting air quotes on technically free, meaning you closed half at 100%, there's still risk, right? And the risk is obviously losing unrealized profit. That is still risk, even if it's not risk against your account principal, right? It's important to understand that there's still risk in those trades. So for example, let's say you have 15 trades and a bunch of them are free. The market starts to pull back and you're leveraged long. The hard part is trying to figure out, especially those guys that have full-time commitments. You're either a professional, you own your own company, you have outside of trading commitments, you have a family, etc. It's going to be really hard to figure out exactly which trades to manage and where to manage them. And all of a sudden, it's going to become very overwhelming for you. And you're going to make some bad decisions. You're going to kick yourself in the butt later. So if there's any advice I can give to any of you guys listening to this that might suffer from that, collecting positions, hoarding positions too many, really try to set a hard rule, 3 to 5 tops. That way, all of your focus is on those 3 to 5 trades. If the market starts to pull back, each one of those can warrant your entire attention. You don't need to divvy it up to a bunch of different stocks, especially trades that you put on 6 months ago that, let's be honest, you don't really care a whole lot about anymore, stuff like that. 20 positions. This guy in particular, Stockby, replying to somebody else, 20 positions at a 12% stop. Reminds him of a mutual fund. I 100% agree. I don't think that there's edge there as a short-term discretionary trader to have that many positions on the books. Focus on a smaller group of high-quality trade ideas. Okay, let's go into trading view really quick, and let's look at some of the indexes here. We're going to look at everything on the weekly, at least in terms of the indexes. SPY, once again, this is the first week down on the year. Now, I do want to point out we are very bullish. We are expecting a 550 plus test eventually. You don't know if it's going to happen this year or not, but we do expect that eventually we're going to be up to 550. And I do think we're going to be at 550 before we see something ridiculous like a 440 or a 420 again. I absolutely think so. But I also think that if there is going to be a pullback, and it does start next week, that just based off of basic technical analysis, you have a previous resistance area that does have overhead supply, and you can validate that with the VRVP. It would not surprise me to see the markets come back down, bounce off this area. It's not just a specific price point, but this area, and then bounce again. I absolutely think that that could happen. One thing I do want to point out, though, is if that does happen, from current price right now, let's go just underneath 478, because it probably will undercut it. Let's go 473 or something like that. That's a 5% drawdown in the S&P 500. Stocks are probably going to feel like they're getting crushed and the world is about to end. If the index itself is down 5 to 6%. The rest of the market is going to be down a lot. So it's going to be very imperative for you that if this scenario happens, you don't run around like a chicken with their head cut off. Understand that this is a very normal market function. We're preparing for it inside of TTI. And your goal here is not to make $1 million shorting this down towards previous overhead supply, now demand. Your job is to buy the bounce whenever it starts to bounce and catch the move up to 550. I'm telling you, that's where fortunes are made. Not everybody is going to be Michael Burry shorting billions of dollars and waiting for the real estate market. Most of you guys don't have the time to be able to do that, so don't play that game. We are expecting a pullback, but still the S&P 500 looks fantastic on a longer term time frame. The Qs, the exact same idea. We're about 1/3 of the way through the move, by the way. We're expecting a close to a 500 area test in the Qs. You can see this is just a very basic range breakout. Once again, though, we are extended off of the overhead supply, 404, 405, something like that, by 6%. So if we're looking for a pullback and an undercut right here, it wouldn't surprise for me to see something like a sub 400, 397, 396. Once again, the S&P 500 could drop 5 to 6%. The Qs are probably going to drop more, which makes sense. They're higher beta, right? That makes sense. Higher beta, meaning that they're going to move more than the benchmark, which is the S&P 500. This could pull back 6, 7, 8, 9%. And if that happens, it's going to feel like the world's going to end. All of the tech plays are going to be dead. They're headed to a new bear market, but just be aware that it's probably not going to happen. This is a very normal market function, so be prepared for something like this. Still, SPY and the Qs look fantastic, and let's talk about what everybody wants to talk about, the Russell 2K. For the first time, realistically, since the end of 2023, and then before that, it was 2021 or 2022 that we're above the 200-day, or not 200-day, the $200 price point in the Russell 2K. We're seeing this come through on the Koyfin stuff. The fundamental, the factor analysis is telling us that smalls and mids are starting to outperform. Is there an opportunity here if the market pulls back for the Russell 2K to the very minimum, start to catch a bid? I don't know if they're going to go crazy with the indexes falling back, but yeah, I think there's definitely an opportunity here. I'm not yet green-lighting this, at least personally, but my eyes and attention are very much on the Russell 2K. If this can hold above the 198.5/200 pivot, I want to be long the smalls and mids for a potential test at the 220 area. I mean, it's very basic range breakout high, but we have been faked out. So we've done a very good job inside of TTI to not play this range. I know a lot of people that have and have gotten chopped out. We're not in the business of front-running stuff like this, especially if you got burned the first time. We're just going to sit here and wait for a higher probability setup. We don't need to catch the absolute bottom. We don't need to time the absolute top on a sell either. We're going to try to catch the 80% in the middle. But right now, smalls and mids, they look very well positioned to actually start to catch a bid here and outperform, at least in the next 2 to 4 weeks. We'll see if that coincides with the market pullback. The dollar finally starting to actually kick everybody in the ass here, right? Going back to the beginning of the year, the dollar is green every single week. Once again, this is one of those weird correlations, which if we go and look at the S&P 500 here and we turn this into a line chart, you'll notice every time the dollar has started to roll over, the S&P 500 obviously has moved the exact opposite way. So you see the S&P 500 bottoming out here was the same time that the dollar peaked. You can see once again the dollar bottomed, the S&P 500 peaked. Once again, you see the S&P 500 bottomed, the dollar peaked, but here we go. Right? The dollar very obviously bottomed, and instead of the S&P 500 peaking, it shot up. So this is one of those divergences where we're sitting here thinking to ourselves, who matters more? Is it the equity world that matters more, or is it the king dollar that matters more? Where you expect the king dollar to eventually kick the shit out of the equity market. So once again, we're not trying to time this, but this is a very threatening move for equities in general. We expect that if the dollar wants to continue to the upside, there's going to be less opportunity for the S&P 500 to continue to outperform, and it's eventually going to react negatively to this and pull back. It's part of our core thesis on why we think this data set, where February through March is inherently weaker. There's a lot of things under the surface here that coincide with that. One of them is the massive performance by the dollar so far in 2024, and the market hasn't cared yet. So here's my $1 million question. Will it care? I don't know. Once again, the bond market and the equity market, as you can see, it happened back in like July of last year, started trading together. They bottomed together, they topped together. The bond market is generally going to move before the equity market because the bond market is the most important market in the world. It's the most liquid. It's where all the big boys play. But look what we found, right? Every time that the market started to roll over, bonds had already made their move, so they're following it. We got the bottom in bonds before we got the bottom in the market in October. But once again, we got the bonds rolling over at the middle of December, late December, and the market, that's it. and instead just completely didn't give a shit about it. So just like the dollar, I have to ask you, does this matter? We think yes. And we think that if the bond market, particularly TLT, breaks below this previous level of support, turned into resistance, turned into support, for whatever reason, this 92 area is sticky. We think that if bonds break below this level, that it's going to increase the likelihood of a market pullback. So we have the dollar telling us be careful. We have bonds telling us be careful. We have market breadth divergences telling us to be careful. There's a lot to quote unquote be careful about. I do want to point out that doesn't mean close all of your longs. As a matter of fact, as you're going to see, we're still long a lot of the market and they're working out beautifully. But it is telling us maybe don't press so much risk to the long side right now and actually start getting prepared for a short side bias trade, at least for the next 2 to 4 weeks. And we are, which we're going to talk about in a second as well. So there's definitely some yellow flags here in the market. Let's talk really quick Chinese stocks, because I know everybody is still jacked up on Chinese stocks. There's not a whole lot here that I absolutely love, but I will tell you that we're finally starting to potentially stamp out a local bottom. Finally. Look at this. Finally, we have broken up and over a 4-week consolidation phase in the market for Chinese stocks. It's on pretty okay volume, potentially going to come up here and flip the 50 RSI. This is pretty constructive for Chinese equities, right? Draw your little trend line, whatever you need to do to convince yourself. I like this move in Chinese stocks. Is it ready to be bought? From my perspective, probably not. But still, it doesn't look terrible. And as a matter of fact, if you look at BABA, there is a hidden divergence in BABA, meaning that each low was met with less and less selling pressure, if you will. There's a lot less enthusiasm into the lows. So BABA starting to show us a little something. Now, there's better stocks in the Chinese market right now than BABA. Everybody's just obsessed with BABA. There's things like PDD that look really good or have at least outperformed as BABA has come down. EDU looks good. Once again, look at the trend here, up and to the right over time. BABA has done nothing except disappoint people, whereas some of these other Chinese names have done really good. You have Tencent, which I don't remember the actual name, or the ticker TME. See, you look at the validity of the trends here. All of them are up and to the right. So instead of just going and just blindly buying BABA, please focus on which areas of the Chinese market are actually outperforming if you want to buy Chinese related stocks. Really quick, tech is very close to our price target here of 215. We don't have actual trades on the tech sector itself, but we are very long tech names. So once again, it wouldn't surprise me to see a pullback in the market because we're extended. We're very extended, right? Very, very extended, very close to some price targets here. Wouldn't surprise me to see the market pull back slightly and then continue on up. Everyone's favorite sector right now, which it should be. This is where everybody's making money or losing money, depending on whether or not you like to trade with or against the trend. But once again, semiconductors, very overextended. We are expecting a pullback. And by the way, we are expecting a nastier pullback in semis than some of the other higher beta areas because there's a lot of froth here. It's not to say semis are not going to continue to lead. As a matter of fact, I think the semi group is going to continue to be the number one performer over the entirety of 2024, just like 2023. Bukowski tells us that market leaders tend to lead for not just like a quarter or two, but sometimes up to like 2 to 4 years. So we think this semi move is here to last, but it's going to be really uncomfortable in my mind if the market starts to pull back because this is just a higher beta area of the market and everybody is levered long this, which if it's a crowded trade and there's leverage involved, there's going to be a more aggressive pullback when the market does actually pull back. So we are expecting semis to pull back rather aggressively. We're not going to short the semi space as a community because we don't like to short market leaders. Instead, we're going to be focused on buying the bounce because we expect them to bounce and lead again into 2024. So once again, don't be surprised if you see some nasty moves in semis and nothing looks more appropriate to illustrate that than SMCI. Right, we didn't trade SMCI. That's totally okay. But everybody was looking to short SMCI for weeks. They finally got it on Friday. All I got to do is people that bought SMCI here, it was on our watch list, but we didn't buy it. Everybody that was screaming SMCI is a scam. These people weren't. Listen, if you're in a stock and it's making money, all of a sudden it's funny how it's not a scam. Even if it's the fundamental guys that bought this thing at $300 that maybe said this thing could trade up to 450 and I'd still own it. All of a sudden it's trading at 700 and these guys are retweeting, SMCI should be a $2,000 stock. It's just like nobody wants to complain that they're in a scam when they're on the right side of the scam. And, also alternatively, everybody that was trying to short the front side of this run up, this parabolic move, are just fucking idiots. The guys that actually nailed it on Friday, either on purpose or complete accident, congratulations. You deserve to make all of the money you made. But shorting a parabolic move on the front side is incredibly dangerous. You can lose your entire account. Fortunately, from the tweets I see on Twitter, Friday made a lot of people a lot of money. So congrats if you're one of those individuals. Here's my question, though. Is there broader implications? SMCI is not necessarily the most important stock in the semi space. That's arguably NVIDIA, and to a lesser extent AMD and TSM. But this nasty pullback in SMCI, is this going to be kind of the kindling for a potential pullback across the entire space? We can look at NVIDIA. Obviously, it reacted negative as well. We look at AMD. Obviously, it reacted negative as well. Now, AMD has a lot more constructive chart than NVIDIA or SMCI, at least if you're looking to buy right now. It's not just complete up and to the right parabolic craziness. But still, is SMCI the first stock to get hit? And are NVIDIA earnings that are coming up on Wednesday of this upcoming week going to be the catalyst for the semiconductor pullback that may start and see NVIDIA drop, kind of a lot? I wouldn't be surprised to see a double-digit drop in NVIDIA. Do I expect NVIDIA to go back all the way to like $400, $300? No, but I wouldn't be surprised to see this come down 20, 25% and absolutely screw a shit ton of people. It's just how these crowded higher beta trades work out. Trades that we took or were in last week, or this week, I guess, that made a bunch of money. ARM. Going to go ahead and show you. I'll link below. We did a webinar on ARM when it actually started to blow up, but we caught the Monday move, right? The Monday move ended up, I'll show you guys really quick. We're already positioned. We've been positioned in this since November, so we were positioned in here. We made over 2,000% on ARM. A bunch of us still have some positions here. We have July $100 calls, I believe, and so we're well in the money. We're expecting this to continue to go up. Even if semiconductors pull back, we expect ARM to continue to roll. We've taken lots of profits off of this. Everything that we have on the books right now is completely free. So these are just batting for the grand slam, right? We're already 2,000 should be a grand slam, right? I think my contracts right now are up 1,400%, but I wouldn't be surprised to see by July if ARM is even higher, continues to get squeezed, whatever, and potentially be able to get out of these for 2,500 to 3,000%. I have no idea. We'll see. But it's a great trade. Good job if you're in TTI. Uber, this is a trade that we put out to the newsletter and on here, YouTube, 3 times last year. So we bought off the 64 pivot as well. We got the big move off of the Lyft earnings, a little bit of a squeeze potentially. Huge move off of Uber, though. We were able to lock in profits, turn this free, and also open up some new positions. You can see here 600% for his February's. Good job, Billy. 350, for April's and the 265s. You can see a bunch of people had the Uber play. I don't know if everyone's going to post it or whatever, but 361, 349. You can see, though, Uber, fantastic trade. Good job. We're still holding a portion of that. Mara and Coin. Why would you not expect these to outperform if Bitcoin's moving up and to the right, which it is, new highs? These always very highly correlated, and these are more efficient trading vehicles in my mind from an equity standpoint than just longing Bitcoin. These give you a leveraged option to trade. Mara absolutely blowing expectations out of the water. Once again, we do have a couple guys that are in the Mara trade. We'll see if we can find that really quick or not. The Mara trade should be up 300, 400% if I can find it, but I don't know if I'm going to be able to find it here. You guys probably already found it. There we go, 423. Good job, Thomas, on being able to play that. We also have some Coin exposure as well. So Coin new 2-year highs and then a pullback on Friday. Still, great name. Nothing to complain about here. If you're trading Bitcoin and you like primary uptrends, which is a series of higher highs and higher lows, and you can hold on through the volatility, you're going to make a lot of money trading this stuff. 2 more trades to the long side, and we'll talk about some shorts. We caught the app push. So very basic setup here. We went through this in a different webinar that I just went over on Thursday. Watch that if you haven't. It's how to trade stage 2 breakouts once they've already broken out. In this case, it was a consolidation fractal underneath a year-and-a-half high, right? So pressing into the supply zone repeatedly, generally a launch pad, and we got the launch pad through ER. We're able to get lock in triple-digit profits off of the app trade. Once again, if I can find it, we were able to turn it free previously, a lot of us at least, and then move into 200 to 300% winners in app. I don't know if I'm going to have a screenshot in here if it's on trading floor. I'm not going to go find it, but just believe me, we're in app. It's up to 300% depending on where you got it. And the last one, obviously, Meta, name that we bought multiple times last year, but also off of the 365 pivot. And we still have Meta's hit an all-time high again this week. This is the communications leader. There's no reason to try to close this early. Once again, I think we still have positions in Meta from the original entry, which, if I'm not mistaken right now, there we go. There's the rest of the positions up 1,100%. This particular portion is up 57, but he's already locked in 55 grand to begin with. So good job on that one, IW Beyond, aka Dustin. Let's talk about 3 shorts that we have on the books right now. We're not overly positioned to the short side, but we are expecting some pullback, and so we want to be able to buy positions that we reasonably expect are going to capitulate. That's the main thing when we're looking to short is capitulation candles. Chewy here. Broad base, we like this going back multiple months into new all-time lows. Don't care about the business whatsoever. Everybody tends to love Chewy, but for whatever reason, the market fucking hates it. So we're going to short this thing. We bought $15 puts. We're expecting just a puke candle, just a quick knife down. We're going to be able to capture some of that if the market pulls back. We're in LPG. This trade's currently down right now, but it is basing underneath, underneath previous overhead supply. So we are expecting once again a move down towards 32. I think we have the $32 puts or the $30 puts. Excuse me if I said that wrong. Either way, we're just looking for a puke candle once again underneath this now support level that's been found. If the market pulls back, we expect LPG to pull back. Once again, it's a fast, aggressive short. We're not expecting to make $1 billion, but it's going to feel good making anything. And then we have some blanket Q puts on the books here. Like I said, higher beta area of the market. If the market pulls back, we expect the Qs to pull back harder than SPY. Since most of us have positions that are growth-oriented tech, communications, some consumer discretionary, stuff like that, buying Qs against that book of trades makes sense to us. They were relatively cheap because we were buying them on the way up. So if the market does pull back, we're going to be able to get out. And obviously we have a stop on those, no price target, but if they lose 50% of their premium or more, we're going to stop out. It was just an insurance policy, and it looks like potentially the insurance policy could pay out. So we're not being forced to close great long trades to save profits, because we bought some Q puts to kind of hedge against that. And hopefully if the market does pull back at the beginning of next week, we're going to be able to make a couple bucks on that. Really quick, we're going to talk about 3 trades that we opened this week. I'm going to go ahead and pull this up in our market research portal. You can look at it yourself. 3 different trades that we took this week. We took the Netflix trade. This is our COD setup. We actually talked through this in the webinar as well, but you can see EP breakout, new base, breakaway gap, new base forming. We took this. We're currently up on the trade. You can go ahead and pause the video to go ahead and look at that, but we grabbed Netflix. We grabbed Disney as well, nearly the same trade idea. So we did not want to focus, or we did not want to buy both Netflix and Disney. You had the decision to buy one or the other. Completely up to you whether or not you wanted to actually buy either of them, but you didn't want to buy both, right? So looking at this, going to the chart, you can see there's an EP breakout and then a potential new base. We bought above the 110. We're currently in profits on this as well. You can go ahead and pause that if you want to read it. And then one more, a more speculative IPO range high breakout. This is the ARM setup. Feel free to watch that webinar. It is linked below if you want to see this exact setup and how we play it. But CART, we like the setup. It's essentially looking like a potential stage 2 breakout. We did buy the dip on this. We did not buy the on the up day there on the day of earnings itself. So we were able to get a discount on this specific trade, and so we were able to position ourselves a little bit better. Go ahead and freeze that if you want to go ahead and read it. But we're in 3 trades this week to the long side: CART, Disney, Netflix. If they don't work, they have relatively tight stops, so we're not going to lose a whole lot. And if they do work, if the market does not decide to pull back, we're obviously going to be able to make a couple bucks on the long side. So guys, my name is Hamilton. I'm here at the Trading Initiative. This is a little bit longer than I wanted, but hopefully there's, for a week that not a whole lot happened, a lot happened. It's just under the surface. And so you should be prepared for both continued price action to the long side, but a potential pullback as well. And if you want access to this market research portal, link is down below. You can take all of the same trades with us, as well as 1 to 2 premium newsletters per day to keep you in the know of all of the most important things, market trends, trade updates, etc. If you find this stuff valuable, feel free to click the link and look how we can help you trade better. If you like this type of content, please like and subscribe. Leave a comment below, and I'll catch you in the next video.